Do you know that 2/3 of Americans are reliant on each paycheck? 24% of them even have no savings whatsoever. Those situations are quite bad, particularly in the long term. Do know that we might have a robust economy, but the price levels won't be coming down anytime soon. Imagine if the US economy was a magic trick. It's like pulling a rabbit out of a hat. You think you've got it all figured out, but then it throws you for a loop. It's all about getting things ready behind the scenes and keeping everyone's attention elsewhere to keep things running smoothly. Now, how about Bitcoin? Is it magic or tragic? It's actually a mix of both worlds. It's magical for those who grasp its risks and have the means to handle them. Yet, it can turn tragic for those who see it as a shortcut to riches without putting in the necessary groundwork. There's been rumors going around recently about the Fed looking into a new approach to tackle inflation, maybe dabbling with Fedcoin or the digital dollar. Details are kept under wraps, but word is they're always thinking up new ideas. However, the notion of making money disappear seems a tad too daring for their liking. They usually stick with the old standbys like tweaking interest rates and using quantitative easing. If you think about pulling a magic trick on the economy right now, making the national debt vanish could be pretty tempting. And it's not just a random worry, there's some real concern about the national debt. Zooming out a bit, the US is facing some tough times financially. The way things are going, the government's money situation doesn't look too great. The debt is growing faster than the economy, which spells trouble down the road. We're essentially borrowing from future generations. It's crucial for us to refocus on prioritizing fiscal sustainability, and the sooner we do so, the better. Despite inflation significantly decreasing over the past year, particularly in the last 6 months, there's still work to be done. The commitment is unwavering to restore price stability for the public's benefit. Considering the recent decline in inflation, there's discussion about lowering interest rates, given the backdrop of robust economic growth and a strong labor market, with unemployment at 3.7%. With these positive economic indicators, the cautious consideration is ongoing regarding when to initiate interest rate reductions. However, more evidence is needed to ensure inflation consistently moves towards the target of 2%. The question arises, why is 2% growth in prices deemed the ideal figure? When setting interest rates, an estimate of future inflation is always factored in. If that estimate hovers around 2%, it implies there's an additional 2% available to cut in interest rates. This scenario furnishes the central bank with more tools, more leverage, to combat a downturn. Having rates slightly higher provides the central bank with more ammunition to tackle economic challenges. During the most recent Federal Reserve meeting, the decision not to reduce interest rates stirred dissatisfaction among many people on Wall Street bets. The reason behind prioritizing price stability is crucial. It cannot be emphasized enough how vital it is to ensure inflation remains low and predictable, alleviating the need for people to constantly consider its impact on their daily lives. This stability was maintained for a significant period spanning 2 decades, and the Fed aims to return to that state. But was the Fed a bit slow to prevent people from pouring their money into nonsensical investments? Looking back, would it have been wiser to tighten policies sooner? The belief was that the economy was so dynamic it would naturally correct itself swiftly. There was also an assumption that inflation would disappear without the Fed's intervention. However, by the fourth quarter of 2021, it became evident that inflation wasn't transitory as initially thought. Consequently, the Fed shifted gears and began tightening policies. This adjustment was crucial, and it's a significant factor in why inflation is now decreasing. So, when will the Fed start to lower interest rates? Is it likely in March? It's doubtful that this committee will reach a sufficient level of confidence by the March meeting, which is in a few weeks. However, is it certain to happen sometime this year? Powell says almost all of the 19 participants believe that it will be possible, in their most likely scenario, for the Fed to cut the federal funds rate this year. But then they'll only reduce by 0.25%, which isn't a significant amount. However, the Fed simply wants to see more positive data along those lines. It doesn't need to surpass what we've seen or even match it. It just needs to be good. So, is there a possibility that prices will return to their previous levels? Well, while the prices of certain items may decrease and others may increase, there isn't an anticipation of an overall decline in the price level. Such occurrences are uncommon in economies, except during particularly dire circumstances. If you consider essential items like bread, milk, and eggs, their prices are notably higher than they were before the pandemic. This significant increase is believed to be a major factor contributing to people's relative dissatisfaction, despite an otherwise robust economy. But will prices ever come down? Well, certain items, particularly those influenced by commodity prices, such as gasoline, have seen significant reductions. Additionally, some food prices, which factor in the prices of commodities like grains, have also experienced declines. However, it's important to note that the overall price level typically doesn't decrease. But what about the banks? Many people invested their deposit money into commercial real estate loans, and those are underperforming. How likely is it that the banks which took on those risks will fail? Powell says that it's not possible. The Fed has examined the balance sheets of larger banks, and it seems to be a manageable issue. However, there are some smaller and regional banks with concentrated exposures in these areas facing challenges, and they're actively working with them. What about the possibility of another 2008-like event? Powell doesn't believe there's much risk of a repeat of it. While there may be some banks that need to close or merge due to current challenges, these are likely to be smaller banks. However, even large banks like Signature Bank, which was ranked 16th globally, have failed. Doesn't this suggest that the Fed isn't infallible, given that they missed that one? Actually, the Fed acknowledged that, and they recognized the need for improvement. Consequently, significant efforts have been made to enhance the effectiveness of supervision and to modernize regulations to address the faster pace at which bank runs can occur in today's context compared to 2 decades ago. And that's about it for today's video. If you liked today's content, don't forget to smash the like button and subscribe to the channel. Thank you so much for watching, and we'll see you on the next one.